Hi, welcome back to Joe Blogs. I've always been fascinated by financial fraud, and when you look at the details of any of these situations, it's always really interesting to work out how they got away with it and why they got caught out. And in today's video, we're going to look at the mother of all frauds, the biggest corporate fraud in world history, Enron, where investors lost $74 billion. And this was a company that actually started out life as a really successful business. It was doing really well in the field of energy trading. But unfortunately, it became a victim of its own success. It was growing so rapidly and the share price was going up so fast that the people involved started doing things that they shouldn't have done. They wanted to keep those profits going. They became addicted to the growth that they were achieving. They wanted to show the markets how successful they were. And unfortunately, they started doing things that they shouldn't have. Now, one of the most interesting things about the Enron story is what happened to one of the largest accountancy firms in the world, Arthur Andersen, because Arthur Andersen were both the auditors and also the consultants to Enron. So they were advising the company what they should be doing at the same time as checking that everything was being done to the letter of the law. But obviously it wasn't, as we now know, and unfortunately this story is not just about the failure of Enron, it's also about the failure of Arthur Andersen and the changes that resulted in the world of finance. Enron was founded in 1985 by Kenneth Lay as a result of the merger of two natural gas transmission companies, Houston Natural Gas Corporation and Internorth Inc. After the US Congress adopted a series of laws to deregulate the sale of natural gas in the early 1990s, the company lost its exclusive right to operate its pipelines. But with the help of Jeffrey Skilling, who later became the company's chief operating officer, Enron transformed itself into a trader of energy derivative contracts, acting as an intermediary between natural gas producers and their customers. The trades allowed the producers to mitigate the risk of energy price fluctuations by fixing the selling price of their products through a contract negotiated by Enron for a fee. Under Skilling's leadership, Enron soon dominated the market for natural gas contracts, and the company started to generate huge profits on its trades. Skilling changed the culture of the company to emphasize aggressive trading. He hired top candidates from MBA programs around the country and created an intensely competitive environment within the company, in which the focus was increasingly on closing as many cash-generating trades as possible in the shortest amount of time. One of his brightest recruits was Andrew Fastow, who quickly rose through the ranks to become Enron's chief finance officer. Fastow oversaw the financing of the company through investments in increasingly complex instruments, while Skilling oversaw the building of its vast trading operation. The bull market of the 1990s helped to fuel Enron's ambitions and contributed to its rapid growth. There were deals to be made everywhere, and the company was ready to create a market for anything that anyone was willing to trade. It thus traded derivative contracts for a wide variety of commodities, including electricity, coal, paper, steel, and even the weather. An online trading division, Enron Online, was launched during the dot-com boom, and by 2001 it was executing online trades worth around $2.5 billion every day. Enron also invested in building a broadband telecommunications network to facilitate high-speed trading. As the boom years of the 1990s came to an end, Enron faced increasing competition in the energy trading business, and the company's profits shrank rapidly. Under pressure from shareholders, company executives began to rely on dubious accounting practices, including a technique known as mark-to-market accounting, to hide their troubles. Mark-to-market accounting allowed the company to write unrealized future gains from trading contracts into current income statements, thus giving the illusion of higher current profits. In addition to this fraudulent activity, the troubled operations of the company were transferred to so-called special purpose entities, which are essentially limited partnerships created with outside parties. Although many companies distributed assets to special purpose entities, Enron abused the practice by using them as dumping sites for its troubled assets. Transferring those assets to special purpose entities meant that they were kept off Enron's books, making its losses look less severe than they really were. Ironically, some of these special purpose entities were run by Fasto himself. Throughout these years, Arthur Andersen served not only as Enron's auditor, but also as a consultant for the company. In February 2001, Skilling took over as Enron chief executive, while Lay stayed on as chairman. In August, however, Skilling abruptly resigned, and Lay resumed the CEO role. By this point, Lay had received an anonymous memo warning of possible accounting scandals. The severity of the situation began to become apparent in mid-2001, as a number of analysts began to dig into the details of Enron's publicly released financial statements. In October, Enron shocked investors when it announced that it was going to post a $638 million loss for the third quarter and take a $1.2 billion reduction in shareholder equity, owing in part to Fasto's partnerships. Shortly thereafter, the Security and Exchange Commission began investigating the transactions between Enron and Fasto's special purpose entities. At this time, some officials at Arthur Andersen began shredding documents relating to Enron's audits. As the details of the accounting frauds emerged, Enron went into freefall. Fasto was fired and the company's stock price plummeted from a high of $90 per share by mid-2000 to less than $12 by the beginning of November 2001. That month, Enron attempted to avoid disaster by agreeing to be acquired by Dinergy. However, weeks later, Dinergy backed out of the deal. The news caused Enron's stock to drop to under $1 per share, taking with it the value of Enron employees' pensions, which were mainly tied to the company stock. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection. Many Enron executives were indicted on a variety of charges and were later sentenced to prison. In 2006, both Skilling and Lay were convicted on various charges of conspiracy and fraud. Skilling was initially sentenced to more than 24 years, but ultimately served only 12. Lay, who was facing more than 45 years in prison, died before he was sentenced. In addition, Fasto pleaded guilty in 2006 and was sentenced to 6 years in prison. He was released in 2011. Arthur Andersen also came under intense scrutiny, and in March 2002 the US Department of Justice indicted the firm for obstruction of justice. Clients who wanted to assure their investors that their financial statements met the highest accounting standards abandoned Arthur Andersen for its competitors. In a similar fashion, the employees of Arthur Andersen also left en masse. In addition to this, thousands of employees resigned or were made redundant. On June 15, 2002, Arthur Andersen was found guilty of shredding evidence and lost its license to engage in public accounting. 3 years later, the company's lawyers successfully persuaded the US Supreme Court to unanimously overturn the obstruction of justice verdict on the basis of faulty jury instructions. However, by then there was nothing left of the firm beyond 200 employees who were managing all of the lawsuits. The scandal resulted in a wave of new regulations and legislation designed to increase the accuracy of financial reporting for publicly traded companies. The most important of those measures was the Sarbanes-Oxley Act, which imposed harsh penalties for destroying, altering, or fabricating financial records. This act also prohibited auditing firms from doing any concurrent consulting business for the same client. So what's the summary and conclusion today? Well, I think the story of Enron is absolutely fascinating because what we had here was the darling of the stock market. At the turn of the century, this company was reported to be the 5th largest in the whole of America. This was one of the big success stories. Everybody wanted to buy shares in Enron because they kept going up and up as the company reported larger and larger profits. But as we've seen from today's video, those profits were fabricated. The company was burying all of the losses that it was making in all of these specs and carried on reporting huge growth. But unfortunately, that didn't last forever. And what came to light was that the company's auditors, Arthur Andersen, should have found out about this much earlier. They should have nipped this in the bud when it very first started. But they didn't. And as we saw from today's video, this resulted not just in the failure of the largest corporate ever $74 billion loss for investors, but also the complete eradication of Arthur Andersen as an advisory firm, because they were exposed as a business that was not doing its job. They were supposed to be policing what was happening with the accounts at Enron, but they didn't do that, and as a result, they became insolvent themselves. And I think one of the most interesting outcomes of the Enron story is the introduction of the Sarbanes-Oxley Act, which changed the way that the world of finance works and imposed lots more regulations. So going forward, it should be much more difficult for companies to be able to get away with things that they were doing in Enron. So hopefully you've enjoyed this slightly different episode. You found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.